We're both investing in companies that develop technologies, but we are addressing different challenges within the CLIC framework. Climate Transition Fund invests in solutions that help to solve the climate challenge, so addressing the carbon emission issues and helping to build resilience to the climate change. In Natural Capital, I'm actually addressing the issue of circularity and lean operations.
The concept of natural capital, the concept of the planet as an asset and a natural asset has been around for some time. Certainly players like EcoEnterprises Fund, and we've been around for a very long time. That's been our underlying investment thesis and really the value that we bring to our investors.
It's important to be proximate to the impact that you're trying to have so that you understand the challenge of execution. I think the recognition of biodiversity loss as a material financial risk to the global economy is another trend that's driving this interest.
Our mission is to mainstream natural capital. To really scale, you have to also have scalable investment opportunities. There's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors.
I'd like today to try to understand what the Lombard Odier Natural Capital Fund strategy does. You could help me start this by giving me an easy to understand definition for natural capital, since we've already used the term a bit here.
I think it's all very fair questions, and it is the right place to start when you're trying to understand the objectives of the fund and the scope of the investments. So when we talk about natural capital, it's basically all the resources that we get from nature, starting with the non-renewable resources, such as, for example, the minerals that we abstract from nature or other materials that we then transform and utilize in our economy and society, to also renewable and regenerative sources that we utilize either as direct inputs, such as, for example, water, or as a service or an enabler of certain activities, such as, for example, bees that pollinate the agricultural fields that eventually enables us to feed the population. So it's really the aggregation of all the resources in nature. Now, why do we need to consider investing in these resources? So I think there are two key parameters or two key factors that you need to consider. First of all, it is estimated that over half of the global GDP directly relies on natural capital or natural resources, be it in the form of physical resources or the services. That means that as a population, we are reliant on nature for our living, and our economy is very tightly reliant on the natural resources. Now, at the same time, what happens is that we are not utilizing these resources efficiently and effectively. So we are over-abstracting or overusing these resources, which then leads to us creating negative externalities to the planet. So it can be by either utilizing or abstracting the resources quicker than they can replenish themselves, or equally just creating negative externalities such as pollution that then eventually harm the natural resources, the nature, and therefore reduce its efficiency and resourcefulness. Now, this whole, if you think about the concepts and the understanding of sustainability globally, this is all still quite a relatively new concept. So we have already seen over the last decade or maybe 2 decades an improved understanding of the climate change, the reasons behind it, and the long-term consequences that eventually translated into willingness to do something about it and address it. Now, when it comes to natural capital, it's much broader. It's equally as important, and it is equally as challenged, but there isn't yet a fully aligned consensus on what needs to be done and how to do it. So one of the theories that we like to consider, and actually it's a theory and the framework around which we're hoping to build measurable measurement tools that will allow us to also quantify the risks and the positive impact, is the framework of planetary boundaries, because it allows you to monitor and assess where do we stand in terms of utilization or footprint on some of these natural resources relative to what is a sustainable manner of utilizing the resources. So we use it as a framework that helps to support and perhaps organize some of the thinking. But this is not a proprietary tool. As opposed to that, we have developed a proprietary tool at Lombard that helps us to translate this whole theory and the concept of the issues around the sustainability, the planet and the way we manage and address resources, the way we operate as a human society, into investable opportunities. And we did that through the concept that you have also referred to when we spoke before this call, which is the CLIck methodology. And we can definitely talk about that, because that's the starting point on which we have mapped or established the key objectives of the investments that need to be undertaken in order to address certain challenges.
Right. Let me quickly add, you mentioned planetary boundaries. What does that mean?
So planetary boundaries is a theory developed around the capabilities of the planet and the certain levels of be it biodiversity, be it chemical content in the planet or in natural resources that keeps the ecosystems and the planet functioning at an equilibrium. And so what we have already recognized that is, for example, the nitrogen and phosphorus pollution stemming from the agricultural activities has already increased to levels where it has significant impact on biodiversity. So we exceeded the limits of the planet to actually absorb and manage or self-regenerate some of these consequences. And there is a number of other metrics that are being monitored and being assessed. And the problem is that we are not integrating this into the investment decision making when it comes to the operations and when it comes to global policies and global behavior of either the economies or the population. And therefore, we're still at the point where a lot of this remains unaddressed.
Can you explain high conviction portfolio?
Yeah, we try to be quite concentrated in our investments. So traditionally, when you go in public investing, especially for broader diversified funds that invest in global equity or perhaps have regional or style biases, you would see anywhere between, let's say, 60 to 100 companies invested in the portfolio. Now, we actually try to build a conviction, meaning that we want to understand the businesses bottom up. We want to be really persuaded and convinced that these are the right businesses from the perspective of the sustainability contribution, as well as just financially sound and attractive investment opportunities. So given that we pay such a close attention to this, we want to construct a portfolio consisting out of 40 to 50 companies. So quite concentrated, where really we would have a very detailed and rigorous view on each of the holdings in the portfolio.
Okay, I got it. And do you have what is the term that you plan to or target to hold these companies?
So our turnover would be anywhere between 30 to 40%, which means that on average, we'll probably hold a company for 3 or maybe just under 3 years.
How did you arrive at that?
It's just historically what I am used to. So our investment horizon is actually much longer than that, because in the sustainability space, the positive contributions and the kind of the outcomes of the focus of the company are such long-term. And so secular and fundamental, that you usually, as a thematic or sustainable investor, you end up looking far beyond the horizon of traditional market participants. So when you're assessing this investment cases and you have a certain view on, for example, the environmental benefits of a product portfolio that you think are going to be benefiting this company because you see the regulation changing or you see the needs of this technology to be adopted, you have a much longer view. And so therefore, sometimes it takes longer until the other market participants actually recognize what you have seen before they did. And so eventually you end up holding the company for close to those 3 years just to wait until your investment conviction or your investment assumption has finally materialized and priced itself effectively in the market.
What do you benchmark against?
I would say we're benchmark agnostic, but of course our conviction is that investing in companies that create solutions to natural capital is more attractive financially, not just from the sustainability objectives, and therefore we would expect to outperform the market. Now, we also have a focus on smaller to medium market capitalization companies. So our reference benchmark would be MSCI All Country World Small, what we call SMID, so small to medium capital market capitalization company.
Now, your fund's philosophy, and correct me if I got this wrong, you want to basically drive the transition from what you call a wild economy, and WILD is an acronym that stands for wasteful, idle, lopsided, and dirty, to the click economy you mentioned, which is an acronym for circular, lean, inclusive, and clean. And just this morning, I was having coffee with my wife, and I said, you know what we're missing? We need more acronyms in the financial industry business. So can you explain WILD and CLICK?
So WILD and CLICK are actually the framework that we have developed for the range of our investment solutions, not specifically for natural capital. So natural capital only sits as, or only became to represent part of this investment framework. What we mean by WILD is basically the traditional approach to a linear business or a linear economic model, where you take the resources, you make products, and then you waste the resources because once you've utilized that, you dispose of it. Now, what we need to create is a certain level of circularity. So the circular part of the CLICK allows for capturing that transition from linear business models to circular business models. But that's only part of the CLICK concept, WILD and CLICK concept. Another part of it is, for example, dirty. So as a humanity, we have been creating a lot of pollution, and one of the key challenges with pollution that we're currently globally facing and globally addressing is, for example, carbon emissions. So within that, we need to transition from the dirty economy to clean economy, which is another part of the CLICK concept. And that we would do, for example, with our climate transition fund that targets to invest in companies that first develop the solutions to carbon emissions, and secondly, also are helping to transition the economic systems into lower carbon emissions. So really, the WILD concept represents the traditional approach that we have lived with for centuries as a humanity, and CLICK represents the number of targets that we as a company think are essential to achieve when it comes to sustainable investing. And then along the clean, lean, inclusive, and clean, circular, circular, lean, inclusive, and clean, along those you develop investment solutions that help to address these challenges.
I'm glad you did that, not me. So is that the difference between the climate fund? Is that's more technology based?
No, so we're both investing in companies that develop technologies, but we are addressing different challenges within the CLICK framework. Climate Transition Fund invests in solutions that help to solve the climate challenge, so addressing the carbon emission issues and helping to build resilience to the climate change. In natural capital, I'm actually addressing the issue of circularity and lean operations. So I am not investing in climate-related transition. I'm not investing in reducing carbon emissions. I'm investing in companies that would create a more lean utilization of resources during the manufacturing process, or that would create closed loop systems in waste management practices, or eventually maybe create biologically based solutions that help to replace some of the chemicals that we're currently utilizing in our production.
And the devil's in the details. How do you actually do this and integrate this theory into a listed equity strategy and get down to what you do, which is selecting your portfolio shares?
Starting with the beginning, or starting with building the investable universe and the opportunity set for the fund. So as I mentioned, we are targeting the circularity and lean practices with the Natural Capital Fund. That means that we're transitioning from the linear economic model to a circular economic model. And we like to think about it in form or in the shape of a butterfly. So what is happening is that in the middle of the economic foundation, you have the linear model, which is abstracting resources, processing them and creating goods, and then eventually these goods are being consumed and disposed of. Now, what we want to do is we want to make this body of the economy leaner, which stands for the first acronym. That means that we need to target industrial processes to increase the efficiency with which we utilize the resources, meaning use less of resources to create the same amount of goods, as well as we need to make leaner consumption activity, which means that we need to increase the utilization rates of the products that we have produced in the economy, because a lot of them actually go wasted or idle. That's number one focus. Then at the same time, of course, while we're trying to minimize the amount of resources that we're utilizing in production and we're trying to optimize the consumption, some of it eventually comes to the end of its life. And so we need to make sure that we reuse this waste and we close the loop by creating a closed loop system. So that's one wing of the butterfly. So we have gone through slimming the body and recircling part of the waste, or the bigger or the maximum amount of waste back into the economy, so we can reutilize instead of abstracting more from nature. And then the second part of the second wing of the butterfly is actually, can we substitute some of these resources that are non-renewable with resources that have self-regenerative features? So can we use nature as a resource in a more effective and sustainable manner? And an example of that could be, why don't we substitute plastic with paper, where actually paper has a self-regenerative features. It's much easier to recircle back in the economy and reutilize that product. But equally, it creates much less harm. And actually, if you have the right production process, it creates positive externalities along the production process. Stemming from that philosophical approach to what we need to do with the economy and the society, we have actually identified the 4 key areas for investment. So we have the circular bioeconomy, which is one of the wings. We have lean industrial processes. We have outcome-oriented economy, which looks at the consumption part. And then we have the zero waste. And once you have identified those 4 key activities, or the 4 key buckets that need to be addressed and developed, the next stage is to identify the business activities that allow you to achieve these objectives. So the business activities within the bio-based or circular bioeconomy would be, for example, smart food systems or biomaterials or efficient management of the water resources. Within the efficient industry, you would be looking at dematerialization. You would be looking at advanced materials that help to improve the resource efficiency. Then in the outcome-based economy, you would be searching for companies that enhance the share and repair within the economy. So again, maximizing the utilization of the products that you have developed. And then finally, the zero waste is everything about collecting the waste, about processing, recycling the waste, as well as potentially reducing the waste in the food system. So it's, again, the optimization and closing the loop.
Do you have any examples you could give of any companies you invested in using this methodology?
It's important to realize that all of these objectives and all of these benefits to the natural capital that this different businesses and different business activities would have are very difficult to assess. I would almost say that it's an ethically challenging question to assess which of them needs to be addressed more, right? Because it depends on a number of different factors. It depends on the cost of the technology. It depends on the necessity or the pressure that you're seeing with a certain particular issue. It also depends on how well the company, specific company within this business, is able to scale the technology. So there is really a lot of points that come into consideration when you try to allocate between the companies. So instead of trying to score or create a systematic approach that will have certain objective assessment of the importance of the sustainability contributions or positive impact that we're creating, we have come to an agreement, or we have come to an assumption that all of these topics are equally important. And so actually the selection of the companies for the portfolio will be based on the conviction that we create around that specific company instead of a result of scoring of the environmental challenges. And that means that we do integrate the ability of the company to contribute to positive objectives that the product or the service that they produce can achieve. But there's a number of other factors that we need to consider, such as, for example, do financials of this company reflect the opportunity, or are they strong enough to actually bring this opportunity forward? Is this company an attractive return on investment? Is this company well managed? And this is where one of the questions that you asked about the CAR methodology also actually addresses not the environmental or social impact created by the product, but the evaluation of the footprint of the company, because we're not only investing in a company that creates positive output or positive contribution, but it also has to be a company that is managing its own footprint in an effective manner on environmental, social, and governance levels as well. So there's really a lot of different factors that need to be considered before you're making the investment decisions. So the CLIC methodology and the focus on preserving natural capital and harnessing nature really comes at the first stages when we define the opportunity, the investment opportunity set. Once we have identified that universe, which currently stands at 600 companies active in the businesses that create these positive outcomes for nature, then you start looking for the most attractive investment opportunities, assessing, of course, the technology that the companies are producing, but equally a number of other factors.
Can you give me one example of a company that you've invested in and how you got there?
So, for example, one of the investments that has been there since we launched the fund is Advanced Drainage Solutions, a company that creates solutions and systems around water drainage. And the reason why this is important for nature is the urbanization of or global urbanization and global development of the cities is actually altering the water cycle quite significantly. By creating urban areas, you're preventing the absorption of water underground, which obviously then changes the content of water in your underground space and then alters the distribution of water. Equally, the inefficient sewage or stormwater management can actually wash off a lot of pollution from the city back into the natural habitats, which can harm the biodiversity. So what you need to do is you need to create very effective sewage systems with minimum alteration of the underlying biodiversity and underlying ecosystems. So advanced drainage systems develop sophisticated systems, and they develop the products that allow for an efficient and effective implementation of these sewage systems. And then on top of that, it's one of the companies that realized the value of sustainability, not only from the perspective of the end use of their product, but also from the design of the product. Over 3/4 of the raw materials that they're using is recycled plastic. So by creating certain design of their product, they're actually helping to close the loop in the economy. So this is one of the perfect examples of a company that creates the product that has a strong positive contribution to, in this case, water resource management, and equally has created that solution on the recognition of the sustainability benefits, which actually led to a significant market share opportunity gains for them.
Back to water again, aren't we? If you had to define the natural capital strategy, maybe you don't want to or you choose not to, but if you had to, is the strategy SRI, is it ESG, is it impact, or is it something else?
I'd say it's closest to impact because we invest with a certain sustainability objective. Of course, we also want and aim to make sure that the companies we invest in are not creating any harm while generating the positive impact. So there is an ESG component to it. But because of the sustainability objective of the technologies that we're helping to finance, I think we're getting closer to impact.
You're not restricted in any way about the type of investments. Do you have a preferred structure or not really?
Our preferred structure is really some quasi-equity piece in which we could get upside, but really retain the ability to get current income, as well as if we do some type of equity piece to get a put or an exit because we need liquidation. So we really look for some type of structured exit mechanism in order to get our money out. So we've learned that we don't do pure equity in Latin America. Just because of the stage, the type of businesses, the exit, cashing out and distributing our returns and capital back to our investors is a priority.
What do you benchmark against?
Well, what we benchmark against is market rates that people are getting on their investments. I mean, we appeal to and attract specific investors that are looking to diversify their portfolio and align their investment objectives with their values, with the sustainability mandate.
What kind of returns have you gotten on your past funds?
What we've made market returns. So Fund 2, let me just say, is winding down, but we're hoping to achieve a 6% to 7% gross on the overall portfolio. So that's for our Fund 2 and Fund 3, where the trajectory is higher than that.
Are your funds open or closed-ended?
They're closed-ended. They're 10 years, 5-year investment, 5-year out.
And typically, what is your exit strategy?
The way that we structure them, most of them just pay out. Most of them are debt-based or debt-like instruments, or instruments that have put options that get paid out over time, or instruments that have royalty payments. So we get cash within that 5 to 10-year period, which ultimately goes back to the investors.
Take me through your investment process. How do you screen and due diligence? How do you get down to actually making an investment?
We've been in business for over 20 years. And we've been in the region for over 20 years. So we know what's happening in the region, and we know where the deals are. So we started creating a pipeline in Fund 1. The deals that were ready, we gravitated and pushed them towards Fund 2. There were a handful of deals that we financed in Fund 2 that we actually saw 6 or 7 years earlier in Fund 1. And the case for Fund 3. So in Fund 3, thus far, we've seen over 400 deals. And the reason being is that we're one of the only players in our particular niche, and that either companies we worked with in the past or co-financiers that we've done deals with, or our investors, or just general solicitations when we're out and about. That's how we generate our pipeline. And so getting back to, we know the industry, we know who are the movers and shakers of the region. We are increasingly seeing the children of some of the traditional business leaders in the region getting into more sustainable businesses. And so we are able to then pursue those deals, but we do a lot of proactive seeking as well as talking to folks. And so that's how we find our deals and pursue our deals. And then once we have a deal, then we do traditional, typical due diligence that a venture fund would do, but of course, within a different context, as in going to that company, going and visiting the suppliers, going and working with the local community. But we also rely on local experts, our lawyers, our financial advisors that are in country to do further scrubbing of the deal. We do have an investment committee that have been working with us for nearly 20 years. Our investors are part of that investment committee as observers. We have an impact committee who provides insight into the environmental and social attributes and aspects of our deal. Our environmental and social management system, which is very much integrated into the investment process. And so we have different risk ratings, whether it's on the environmental and social side or on the business side. Part of our due diligence, it's across the board, the type of analysis, evaluation, and scrubbing we do for every single transaction. And because we do work a lot in agriculture, we do work in forestry, agroforestry, aquaculture, and even in the emerging opportunities, the team has been working together for more than 10 years, close to 20 years. And so the team has seen a lot of similar transactions. And so we look at the cross-learning at the portfolio level as well as the team level, and then allocate the deal bought into.
What is the ticket size that you look for?
So we look for deals that really are the minimum sales level of $1 million. So we want to see some operating history, although we've done a few new ventures that have come out of existing companies. But our ticket size ranged from about $1.5 million to $10 million. And we like to keep it about $3.5 million. So for instance, some of the companies like on the ecotourism side, they're smaller ventures because the footprint of an ecotourism operation is very important to us. Small is beautiful, and you really can't deploy more capital into those type of ventures. Part of the investment strategy is putting some money on the table and then do follow-on financing, either tranche our initial commitment, of course, based on milestones and based on benchmarks, but then also try to pile into some of the winners to help them scale further, expand beyond a country, more regionally, into other products, into other innovations. That's part of the strategy. Fund left, the Conservancy made a push and established NatureVest, and you've probably heard, which is really their umbrella where instruments like this, like EcoEnterprises Fund, has come into, and that incubator or that accelerator that they've worked on for many years.
Your funds have grown in size in terms of AUM over time. This market evolution, is it an evolution in supply or is it demand for capital?
For our fund, it's a combination. I mean, one of the things that we've always said, or I've always said from the beginning, is that we will stay in business if there is a need, and if we could provide that leadership and that creation to help create the market. Once local organizations, the local capital markets, if in Latin America, if they take this on, then that's great. We work ourselves out of a job. But right now, the capital markets in the region are not focused on these transactions, are not providing the type of capital nor that high touch, that they're not sophisticated. They haven't gone to that level yet where we're seeing the bubbling of it, but they haven't gone there yet. And so there's still a need for us in the market. There's still a need, increasing need for more capital because there's a lot more demand and there's a lot more investor interest.
Why is it mainstream capital is overlooking these transactions?
It's risky.
But
so markets go towards where they can make the best bang for their buck. So in Latin America, for instance, there is much more of a vibrancy associated with tech deals, with education deals, with health deals, with renewable energy. It'll get there sooner or later, but it's not there yet. Plus the type of returns. I mean, we're talking agriculture. We're talking rural areas. We're talking working with local communities. It takes long. It's not a short-term investment. It's a long-term perspective, and it requires a digging deep and driving it.
You mentioned that you're high touch, and I guess you're referring to that your portfolio companies, you provide technical assistance to them. Can you describe what that looks like and why is that important?
Yes. So what we want to make sure is that the company has all of the elements that it needs in order to succeed, right? So some companies are very strong on financial management, whereas other companies are not. So the business advisory support that we bring in, we really try to identify where we could add value, whether it's forecasting, whether it's financial management, whether it's cash flow, whether it's pricing, or of course, whether it's marketing or governance. So a lot of times small companies don't have a functioning board of directors, don't have functioning shareholder communication, all of those base elements that that you recognize. We recognize that a company needs internal capability and capacity. We help support that. We identify it. We help support it individually and on a one by one. In different cases, we bring in consultants or specialists that can help the company. And that goes for environmental and social as well issues.
Is that the cost to the fund or is that a cost to the company?
So for the most part, we pay for it, but we do have in Fund 2 as well as Fund 3, we have one investor that is willing to put up matching monies. So we do have some matching monies in both funds that enabled us to provide grants or to buy the services of someone to add value.
And tell me what the profile of your fund's typical investor is and why do they invest with EcoEnterprises? Is it passion? Is it mission? Is it returns? Does it matter?
We have a track record. We have experience. We've been here for some time. What they see is what they get, as well as we're extremely transparent. And investors, if they want to participate at the investment committee level, at the impact committee level, or come down and visit our companies, they're most welcome to do that. So it's a very engaged investor base. And many of the investors from Fund 1 have come into Fund 2 and Fund 2 to Fund 3. And so that continuity has always been one of our secret sauces.
Right.
So.
Right. That's always the best report card when someone goes from fund to fund. You're on your third fund now. How have your investor profiles changed over time?
Yeah, I think just overall, I think that there's more interest in private investors, from family foundations, from family offices who are interested not only in learning about the space, but co-investment opportunities. So I think that's where we see a little bit more uptake. We have the same sort of institutional investors that have been consistent over time, like development finance institutions or larger foundations. But from a private investor point of view, both European private investors as well as U.S. private investors investors, we see much more interest and consideration for our types of funds.
Right. Are these specialized private equity investors? Are they big players or small players?
Yeah, you get a mix, I think. One of the things that we have always found important was that if there is a US or European investor that wants to come in for a small amount, that we are open to that because we see it as our sort of effort to be a change agent, to get to provide that communication, that education, that learning about the space, to see that investing where we invest in our niche is a appropriate investment strategy and a good investment strategy. And so consequently, we do have some investors who came in with small bite sizes in an earlier fund and then up their commitment in a later fund.
Do your investors in your fund have downsides that are specific to your strategy? Obviously, anybody investing is exposed to overall large macro market or regional issues, but are there any downsides that your investors are exposed to that might not be the same for macro investors?
Yeah. So one of the things that I guess I should note is that we've been extremely transparent in the learnings. And so there have been instances where things went south or things didn't work out. The situation didn't work out that we expected. But we actually published all of those lessons from Fund 1 in a book that came out in 2011 called Portfolio for the Planet, 10 Years in Lessons Learned. And you may have seen it on our website, but we're actually in the process of doing a revised version of that for Fund 2 that catalogs and reflects learnings and what we saw in deals and case studies so that others in the field could learn from it. Because we have found that, especially early on, that there was not much communication as to what worked and what didn't work. And so now, 20 years plus since, we know what works and what doesn't work so that our investors, going back to what you noted, our investors could see, oh, this is the way that they structure deals, or this is what they learned from this situation, or this is how to diversify their portfolio. So avoid some of those macroeconomic risks that may come to a country like Brazil, but be avoided in Ecuador, whatever.
Right.
The only other risk, obviously, we do have a whole sort of strategy at risk mitigation and like any sort of investment shop. And we also have a very comprehensive environmental and social monitoring program, because one of the things that we're very, very mindful and very sensitive about are the environmental and social benefits that accrue from our companies, any impacts that could take place at a small producer or at a company level. And so those type of our concentration on how to manage those risks, how to enhance environmental and social outcomes, positive outcomes, that is also part of our strategy. Getting back to risks on the investor side, I think investors continue to buy into sort of our track record or sort of what our approach is, because they see that we have those frameworks in place. We have those systems. We know what we're doing in our particular niche of business. And so that then mitigates some of those other factors that you are you're alluding to. In the first book, and we put it forth, what happened was we invested in the first organic spice company, and at one time in the marketplace, the cardamom prices went through the roof. And so the local community that the spice company was working with decided to cut down trees to plant more cardamom versus a sustainably managed approach. And so what did the company do? The company worked with the small producers in the communities to plant trees, to do reforesting, to work on supply and demand dynamics, to work on improved certification schemes. So those realities do come up over time. And today it's a much more sophisticated approach than it was 10 years ago or 16 years ago. But nonetheless, those things where that's what we try to address and try to get on top of as soon as possible.
You're one of the pioneers in the natural capital investment sector. Now, because of trends or maybe fashion or whatever the dynamics are that are driving it, there are new entrants looking to raise significant amounts of capital in the sector. For example, the HSBC Pollination Fund that's targeting, I think, something like $1 billion. What's the implications of these new entrants into natural capital in the region you're in, Latin America? Is the market constrained by a lack of suitable, profitable, nature-based businesses to be able to deploy capital? And if you have such large players coming in, is there a risk that these big companies will come in and in the end we'll end up with more impact washing? Is there enough pipeline and opportunities out there for large players coming in who are, significantly larger than the AUM you have right now?
Yeah, I think that this is how markets evolve and how businesses transform. And I feel like the HSBCs or the BlackRocks or the JP Morgan Chases of the world, there's a lot of large funds out there that are raising capital for natural resource-based companies or social impact enterprises. And I feel like our niche is quite different than what the deals are that they will be targeting. So that there are infrastructure deals, there are renewable energy deals, there are companies that get beyond our bite size because they scale that might be applicable pipeline for these other players. But certainly I find the complexity and the dynamics and what is needed at our level of investment to be such that certainly I don't see that these other players will be co-financiers in our deals anytime soon. It may be a Fund 5 situation, but certainly Fund 4, we're not even seeing it.
How would you distinguish between what you're doing and where you think they'll be playing?
I think that we deploy smaller amounts of capital. I think if you have $1 billion assets under management, how many deals can you actually manage under that portfolio? And so a lot of the players that were looking to get into this space versus going directly and doing a venture approach, like they went through financial intermediaries. So, for instance, there are a lot of the microfinance institutions that have gravitated into more of the small to medium size investment niche that has put more money to work in regenerative agriculture or some emerging technologies related to nature-based solutions. I mean, as fintech is very hot, so there's a lot of money going into it. And so some of these deals are much larger than sort of our bite size. And so there have been attempts to get at smaller deals like we're focused on, and really a lot of investment has gone into financial intermediaries in the region, which is very good because it still gets more capital into these deals. But as in the private equity or the venture business in Europe or the United States, it's extremely active. There are a multitude of players. Everybody has their area of expertise. In some cases, they co-finance or they compete. And the capital markets are not as deep in Latin America for these type of deals yet that I see those playing in our space.
What does impact washing look like to you in your region, or is it even a thing?
Well, when we started in this business, in 1998, it was greenwashing. So now is the new term impact washing. It's the same in my mind. So there'll be deals that are repackaged and now say they're environmental deals. There'll be agri deals that are repackaged and now say tech deals. So, I mean, you know what? I feel like it behooves us in terms of awareness and in terms of change to get these terms out there, to get the conversations going, to get large studies. I'm sure maybe as part of your research, you looked at Sculpta review that came out by the UK Treasury on biodiversity earlier this year. There's a whole sort of push towards biodiversity and natural capital that could only bode well.
Mm-hmm.
As an investor, that's what your due diligence is all about. I mean, investors, when we raise our fund, there are similar type funds that may be capital raising at the same time. And I've heard on numerous occasions, oh, that fund down there is promising 25 to 40% returns. And I'm like, okay, I've been in this business nearly 30 years. I've never seen that. More power to you if you can find it.
Then in 2009, you started a 13-year run at the Nature Conservancy, which is a non-for-profit. I guess I understand from your last comment what prompted that. You were looking for a job after the Great Recession. Tell me how you landed there, and I'd like you to explain exactly what is the Nature Conservancy and what do they do?
Yeah, so as you noted, I was looking for work, and it was clear I was not going to get a job in finance at that moment in time. And the Nature Conservancy, which is the world's largest environmental conservation organization, it's got about 5,000 staff. It operates in more than 75 countries. It also began life as a land trust, buying land for permanent protection. So it's a very transaction-oriented, pragmatic, solutions-focused NGO. It is not an advocacy NGO. It is not a policy NGO. It is a deal-doing NGO, is how I would characterize it. And had recently hired to be its new CEO a man named Mark Tursick, who had previously been at Goldman Sachs for a long time, and had his most recent role there had been the head of their environmental division, where he had overseen the first document published by Goldman Sachs acknowledging the risk of climate change to the bank's portfolio. So I was put in touch with Mark through a mutual connection, and he was trying to build out the capacity of the organization to do kind of business-oriented conservation work. So I was hired to launch a product that would allow people to lend money to the Nature Conservancy instead of give it to the Nature Conservancy. The organization has, I won't know the asset base at this point, but it's north of $6 billion and a AA credit rating from Wall Street. So the idea was to create kind of a retail debt product that would allow people to lend the organization money. This is at a time when people were quite skittish about philanthropy because, again, the bottom still hadn't hit in the market. And so the organization was looking for liquidity from a different source. So I launched this program, the Conservation Note Program, and raised about $60 million for the next few years through that. That's how I got to the Nature Conservancy. It felt like a place where innovation was rewarded. There was huge scale when you can think about, the organization's footprint and opportunity to do new things and really try new ways to deliver outcomes that there's huge scale at the Nature Conservancy and opportunity to try new ways to deliver meaningful impact. And that's something I really have always loved about that organization is it's focused on very tangible results. So whether that's raising enough money to do really meaningful conservation or delivering science that allows for better decisions, it's very tangible.
What's the origin of the organization?
It was launched in 1951 by a number of scientists in New York who mortgaged their homes to buy a piece of land called Mayanis Gorge in Westchester County, still there, still protected. And then they started trying to raise money to buy land to protect it forever. And then realizing that was not going to get us where we need to go, it developed sort of an increasing number of programs around policy, around engaging with corporations. It became an international organization in the 90s. There's actually a great book about the history of the organization called Nature's Keepers, which tells the story of how it grew from small, few hundred person NGO to now.
You started out as a manager there, but then eventually became the managing director of NatureVest, which was something very transaction oriented. What led to the establishment of NatureVest and what role did you play in setting that up?
Yeah, so in 2012, I think, the Rockefeller Foundation and JP Morgan issued a paper, Impact Investing, a new asset class. And one of the things that we learned in launching the conservation note is back then, socially responsible investing, the term impact investing hadn't been coined yet, right? In 2010, 2011, was almost exclusively focused on social and community impact. And putting the note into the market, people reacted very positively. Oh, I love, my values align to conservation. I love the idea that I can invest along with my philanthropy and deliver on my values. I've been looking for something in the environment space and investments forever. I'm so glad this is here. What else can you give us? And so the impact investing market grew. It sort of became this tide that lifted a strategy inside of the Nature Conservancy. What else can we do? We are transactional. We think about value. We think about structuring deals. What else can we do that wouldn't require philanthropy, but we could do with investment capital? And so we asked that question and secured inaugural funding from JP Morgan to build out a team that would answer it. So I was part of the team that founded NatureVest. We launched in 2014. I led the transactions team at that time. And then in 2018, took over the whole program.
The Nature Conservancy is partnering with companies like JP Morgan Chase, which I think I'm right when I say is the largest global funder of fossil fuels.
Yep, you're right.
Achieve their biodiversity and climate change goals. And the Nature Conservancy is this kind of giving people like JP Morgan a brand benefit and somehow kind of a green sellout?
It's a fair question. And the answer isn't always obvious or straightforward. I mean, I think one of the things, so there's a principles-based answer, which I really believe in, which the Nature Conservancy holds, which is it is better to work with these companies and meet them where they are and move them than it is to, ignore them or wish they went away or fight them. And I think that is true. And then, of course, how it operates in real life day to day is another question. And I know at the Nature Conservancy, they have very good lawyers really focused on ensuring that any collaboration with a private entity was not creating undue private benefit and that it was delivering really meaningful conservation impact. So the idea being you can do more if it is the case that you can do more for conservation through a collaboration without creating undue private benefit, then it is worth it to do. And so I think taking the funding from JP Morgan, does it create a halo effect for them, in real life? Certainly it does. Were we able at NatureVest to protect hundreds of thousands of hectares of ocean and hundreds of thousands of acres of land through transactions that we structured thanks to JP Morgan funding? Also, yes. And which is worth more? I would say the conservation benefit is worth more than the kind of halo, and therefore kind of the trade is worth it.
That being said, you sat on both sides of the table. Do you step back and worry about greenwashing?
I mean, in general, yeah. In that instance, no. I also think there's a really important role. I think the environmental nonprofit community is an ecosystem with everybody playing their role, right? And I think banks like JP Morgan are excited to work with the Nature Conservancy because the advocacy organizations are pushing them to do more, and then the Nature Conservancy offers kind of a pragmatic way for them to do more. So I think there's a role for everybody to play in keeping us all honest.
In 2022, you left the Nature Conservancy for the Timberland Investment Group in BTG Pactual. What was your motivation? How did that move come about? And I guess you came and are the head of impact finance there, right?
Yeah. So I'd been at TNC for 13 years, which is the longest stint I've done anywhere, and really loved it and was really proud of what we had accomplished at NatureVest and what we had built. And it was starting to feel like the wheels were on the bus and the bus was driving, and maybe it was time for a new adventure. And I knew the TIG team because of the collaboration that we had set up the year before, where the Nature Conservancy is the conservation advisor on our North America strategy. And so when I was looking around for who else was doing cool things in the space, they were a very obvious phone call. And so we talked about my joining. We developed this new role, head of impact finance, where I'm now in charge of creating an impact strategy for the whole portfolio, as well as as managing the relationship with the Nature Conservancy, which is, of course, really fun for me to continue to work with my former colleagues very closely. So it made it a very easy and happy transition.
If you could provide me a high-level introduction to BTG Pactual, just paint the big picture and then say, where does TIG fit in that? And then tell me about TIG and what your mission is and what you're trying to do with impact investment strategies.
So BTG Pactual is the largest investment bank in Latin America, headquartered in Brazil. It has all of the functions that an investment bank has. And we sit within the asset management division as an independent subsidiary. TIG, the sort of original company, was called Equator and was founded in 2007 by 4 partners who all still work for the company to invest in forest management and environmental products. Became a subsidiary of BTG in 2012 when they decided to move from forest management as a service to forest management as an asset owner in Latin America, where you're required to be a Brazilian entity if you want to own land in Brazil. And so that's the history of how TIG became sort of part of BTG. We operate fairly independently, and in 2013 acquired a portfolio of North America assets that became the base for the North America strategy we have today. So now we are about $6 billion in assets under management, makes us the 3rd largest timber investment management organization after Manulife and New Forest. Although I think it's worth noting New Forest is about 50% ag, and that's exclusively the New World. So North America and Latin America, we have about 3 million acres, roughly 60-40 U.S. and Latin America. And our mission is to sustainably manage those timberlands in ways that exceed industry best practice and deliver positive outcomes for nature and climate. Most of what we own are very conventional working forests. In Latin America, that's pine and eucalyptus plantations. In North America, it's pine, hardwoods, and softwoods in the Pacific Northwest. And we are working, my job is to create impact strategies for those really core timberland assets to try to, at scale, deliver benefit for water, for species, for biodiversity, for climate. We are in collaboration with the Nature Conservancy on our North America portfolio. So that really gives us a huge kind of asset in terms of that organization, scientists, forest management experts, spatial analysts, to identify where across the footprint, we have about 1.1 million acre footprint, are the best opportunities for endangered species protection, water quality improvement, other biodiversity benefits. And then in Latin America, we also have a reforestation strategy in collaboration with Conservation International, where we are creating new forestry assets from degraded cattle pastures and restoring about 50% of that portfolio to native forest for permanent protection. So that's us.
You are an asset manager. Does that mean you have outside investors that invest and then you're making and managing those investments? Are you a fund?
Yeah, we have a number of different investment strategies.
Who do you consider your competitors?
So you could think about competitors for capital, right? And so then that would be the whole forest investment management sector, New Forest, Manulife, which has been formerly called Hancock, Forest Investment Associates. There are a number of good other companies out there. And then competitors for assets, those who share our footprint. So that would be Forest Investment Associates, New Forest, and others who are in North and South America.
And are you a certified B Corp?
No, we are not.
Can you explain the traditional role of forestry in investor portfolios? What's the attraction of the asset class and conservation finance?
So traditional timberland investing has always been appealing to people with very long investment time horizons, so pension funds in particular. It is an uncorrelated asset to inflation, so people see it as a hedge there and to the stock market. And so people see it as a good diversification strategy as well as a good inflation hedge. It's generally cash yielding. Yields are not competitive with private equity, but they are competitive, have been historically competitive with public equities for the long term. And it's a real asset. So people who would like to have real assets in their portfolio and find forestry attractive. Of late, there's been a huge, as you know, shift in the global capital markets where $150 trillion has committed to being net zero by 2030 in the last 4 years. And I would say most of those investors don't know how to do that and have noticed that trees sequester carbon. And so there's a really burgeoning interest in timberland investing as a carbon sequestering investment relative to any other kind of major asset class. Just growing trees and harvesting them takes carbon out of the air, and long-lived wood products keep it out of the air. So it becomes a very low carbon positive investment for investors who find that important. And then, of course, we're trying to do more than that in terms of having additional benefit for climate and biodiversity.
These last things you've mentioned are really the non-financial attractions of the asset class. So one thing I feel you're somewhat different or unique on is the impact aspect, because usually discuss real assets and forestry more in the context of sustainability, but you specifically are discussing impact, which technically there's some additional criteria. So how should impact investors think about an allocation to timberland?
Yeah, it's a very good question. And I will say the sector, I think, is a very sustainable one. Our peers are all excellent in terms of sustainability. A long time ago that people wouldn't replant trees after harvesting them. Impact, as you say, is different. It's trying to create additional benefit to communities, to nature, to whatever constituency outside of, good management and sustainable management. So I think investors who are thinking about impact should look at timberland investment managers, ask what is their impact strategy, what is their impact framework, and how are they delivering additional benefit beyond business as usual.
So then what is the circular bioeconomy and what will it become, with this increased focus on biodiversity that you alluded to and the increased focus on nature?
In the early days of market economies and the capital markets, labor and money were very expensive and natural capital was free. And today we realize the cost of labor has gone down, the cost of money, while now higher, has gone down. But natural capital has a huge cost because it is finite. And so the circular bioeconomy values that natural capital and invest against it and for it in a different way. So as an example, traditional agriculture, industrial agriculture as it's practiced today, could be considered an extractive industry in terms of the soil impact, the water impact. Something like regenerative agriculture seeks to be a renewable industry, putting back soil quality, putting back water. And so the circular bioeconomy really relies on a renewable approach to resource use. One example that we're really excited about for obvious reasons is mass timber, which seeks to replace extractive materials, concrete and steel, in building so that buildings can become carbon sink instead of emission machines, and can create increased demand for forest products, because the more demand there is for forest products, the more trees people will plant. And the more trees people plant, more carbon comes out of the atmosphere, and the better for soil and water and biodiversity.
Is this the main trend that's driving interest in impact-driven timberland investment? Because I keep thinking, I just haven't understood the word impact used a lot with timberland investment.
Yeah. No, I think that's one of the big trends. I think this net zero trend is another very big trend because, of course, traditional sustainably managed timber is not creating additional carbon sequestration. It's just sequestering the carbon that it does as an industry. And then I think the recognition of biodiversity loss as a material financial risk to the global economy is another trend that's driving this interest.
What is your impact strategy and your theory of change?
Probably the easiest way for me to answer that is to give an example and focus on our collaboration with the Nature Conservancy in North America, where we have, as I said, this core timberland portfolio really focused on execution, managing a set of assets for financial returns and sustainable output. And then we've brought in the Nature Conservancy to look at how we can, within the context of that strategy, deliver impact. Obviously, because of who they are, their focus is primarily on biodiversity and climate impact. So I'll just speak about those two here. So the Nature Conservancy has assessed this whole 1 million acre portfolio and seen, okay, here about 30% of this land is really important for biodiversity based on our analysis and our data sets. And within that 30%, here are the practices that you can put in place that really will benefit biodiversity in the context of a working forest. So one example is in places where there's really important aquatic habitat, we're doing more with streamside management. We're creating wider buffers. We're retaining more trees in those buffers. We're buffering ephemeral streams, which are seasonal streams. And we're doing all of that under their guidance. Or in the Southeast, in pine forests, we're doing some uneven aged thinning as part of our management practice to create a diversity of light levels and a diversity of forest structure, which is really important for species to live in that forest. We're doing prescribed burning in fire-managed ecosystems in a way that targets really critical biodiversity hotspots in our portfolio that allows for restoration of native species to create, more habitat. So those are examples of ways that in the context of a working forest portfolio, in the context of practices, we're harvesting trees, we're doing thinning, we're creating streamside management zones already, but we're tweaking those practices so that the biodiversity benefit can be optimized.
The way you described it sounded like you were talking about perhaps a pre-existing portfolio you had.
Yes, in that case, it's a pre-existing portfolio, yeah.
But I presume you're actively fundraising and deploying more capital, so you're looking for new targets. Is it a similar process?
Yeah, it's a great question. So in North America, we're fundraising. We'd like to grow the portfolio, and whenever we identify a potential new acquisition, the Nature Conservancy looks at that. There's a set of rules that we've both agreed to where we call them minimum acceptable standards, where, they make sure that the asset meets those. And if it doesn't, we either shouldn't buy it or we should have a plan to bring it into compliance. And then beyond that, they're saying, this is an opportunity for permanent protection. We can bring in some conservation finance here. Here are the management interventions we'd recommend you make. This has the species on it. We're very excited about this. So then there's this preliminary development of some conservation strategies around that asset prior to acquisition, and then we can start rolling those out once it's in the portfolio. They're also kind of guiding us. They have created a map of where the biggest benefit is to keeping land in forest and where the biggest benefit is to having responsible forest landowners. And so as we're looking at, obviously we're not in charge of what comes up for sale every year, but it helps us to know, this is an area that they're very excited about. Let us keep going after this asset because the benefit's going to be greater.
Do you have any kind of impact screen that you apply that are up front and foremost when you evaluate potential investments alongside the financial criteria?
Yeah, it's these minimum acceptable standards that I described earlier that really focus on the asset delivering benefit as a timberland asset and not doing any harm. And then, so it clears that hurdle. We still haven't made a decision if we're going to go after it or not, because if it didn't, we wouldn't. And then the Nature Conservancy will continue their pre-screen work. And there isn't a numeric target in the short answer to your question, but there is a assessment that's done of the opportunity for impact. And if there's greater opportunity, we are going to be, assuming it clears our financial hurdles, all else being equal, that's an asset that we're going to want to pursue more than one that has less opportunity for impact.
And is your investment strategy different in the different regions internationally that you work in?
Oh, good question. So outside of the U.S., our core Timberland portfolio, we're really primarily focused on assets at scale where we can, manage at scale. And we develop an impact strategy post-acquisition. We also have a reforestation strategy where we are, as I said, in collaboration with Conservation International. And there it's similar, kind of a iterative, here's something that we could buy. Does it have good impact? Yes, we kind of go work together with Conservation International to ensure that our portfolio is optimizing impact within our financial hurdles.
Is there any acquisition that you could describe how you viewed it in terms of impact, how you got to the decision to pull the trigger on it?
I can give a negative example. So we were looking at an asset for sale in the U.S. that was somewhat outside of our core geographies in terms of, we're trying to keep our assets somewhat clustered for management efficiencies. But we showed it to the Nature Conservancy because we thought if they found it very exciting from an impact perspective, we would push harder to go after it because we would have an opportunity to deliver more impact. Turned out they were not excited about it, and so we walked away. But that's an example of how our impact priority would have, affects our acquisition behavior, if that makes sense.
So let's talk now about climate asset management. So give me a high-level introduction and overview of climate asset management, and include in that what's your mission and what's the company's main activities and key strategies and number of funds, etc.
It's very simple. Our main mission is to mainstream natural capital. So one of the observations we had in the beginning was that natural capital to this point was very much of a niche product. So there were lots of smaller impact funds, some very good, as Tammy's fund, for example, but they were relatively small. And what I learned at the European Investment Bank was that in order to really scale, you have to also have scalable investment opportunities. Otherwise, you can't attract real mainstream investors. So in a way, that's really the mission that we're having. We want to build a very large scalable business around natural capital. I think we saw, if you think about almost like a Venn diagram, we saw basically the smaller impact funds. We saw the more mainstream agriculture fund and the more mainstream forest and timber funds, or TIMO supported or TIMOs. And our analysis was that in the middle of this Venn diagram, there's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors. And that's what we created. So we started off in our first investment strategy is a real asset strategy, where we're offering to institutional investors to invest in underlying projects, mainly around agriculture and forestry. And what we're doing in a nutshell is we are, for this strategy, we are buying land in developed markets. We always have a thesis why we're buying the land and how we improve it, how we improve the impact, but also the economic return. And then we're selling it after 15 years. From a business perspective, so the way we make money is that we are creating sustainable yield. And the thesis here is that often you can create better long-term yield if you have a longer investment horizon. So for example, on the agriculture side, the traditional model has been to invest, usually to lease lands, and then to have an investment around 6, 7, maybe 8 years. And then by definition, you're required to get as much out of the land as possible, usually with not very friendly environmental practices, using a lot of pesticides. So we wanted to turn this around and saying, if we had 15 years, what can we do? We can actually implement very sustainable or more sustainable practices that also create over time, over the 15 years time, better yield, and they enhance the value of the land. In addition to that, we also look to bring in new revenue streams from natural capital. It could be CO2 for forestry projects or carbon credits, but it could be also conservation easements in the US. And we also measure all the biodiversity so that should there be a possibility to also receive a financial return for that we will then be able to also integrate this in our strategy. So that's one strategy. Maybe I pause here because I'm sure you have lots of questions.
You have two main strategies, correct? One's
that's right,
natural
yeah.
capital and the other is nature-based carbon.
That's correct. And that's the one I used to head. And that's a completely different strategy. So here we looked at what other opportunities do we see around natural capital. And one thing we saw is that corporates came to us and said, look, we have a net zero target. We know already today that we won't be able to fulfill this with own action alone. So for the delta or the last piece in the puzzle or the last part of the journey, we will have to buy some carbon offsets. And what we want to do is don't want to go now to a broker and buy them. We actually want to invest in projects, high quality projects from nature or natural capital that can generate high quality offsets for us over a longer time period. And so we created as a second strategy also a vehicle that allows corporates to put money upfront into projects And what we're doing is we're not buying land because it's an emerging market strategy, but through a contractual arrangement, we basically are able to prepay projects and pay for high quality carbon credits on delivery over time. And that strategy, we are not delivering a financial return, but with that strategy, we are actually only delivering the carbon credits back to our investors. So we have two very different strategies. On the one hand side, a very more classical real asset product for institutionals. We have mainly insurance companies in there and some pension funds. And then we have the other one, which is a corporate product in emerging markets where we're helping them to invest in and source high quality carbon offsets. And so that also allowed us to run these strategies in parallel because they're completely independent from each other, but we can actually cross-fertilize some of the talent and some of the experience that we have in the firm.
Just to fill out the picture on climate asset management, how many funds do you have and how many employees and just a few other things just to get the high level?
We have those two strategies, 3 vehicles, and we have now over 40 employees.
3 vehicles, meaning funds that you're using. Are these open-ended, closed-ended funds?
They're all closed-ended. They're all 15 years, and we think that's one of the key criteria, that in order to make natural capital investing workable, one needs a longer time horizon. Actually, I think it would be even easier if you could go longer. However, that's very difficult on a closed-ended basis with many investors.
So roughly double the average private equity fund.
I would say the more comparable funds on the forestry side or on the impact side is probably 10 years, I would say. So it's probably...
I don't know if you publish AUM, but do you have any kind of reference point?
We raised over 650 million at the end of 2022. We are now at the moment finalizing our fundraising. I can't give you the final number, but we are well advanced on that and will come out in hopefully after the summer this year with our final number, but we're in a good way.
And when did you start fundraising? Was that 2020 or was it 2020? 21. Right. Okay. So before we drill down more on the specifics, give me a clear definition of nature-based capital. And so everyone's starting at the same point as where Martin Berg is, and explain to me why it should be important to investors.
Sure. Well, we call it natural capital, so for starters, and what we basically refer to is basically you say the earth, air, land, water, and biodiversity. You can think about it as the earth planetary infrastructure, if you will, and that infrastructure is providing a service. In very simple terms, the bees through their pollen help us to almost sustain life on the planet, and yet we're not providing any value to the services the bees provide to us. And that's, of course, a known fact. But I think now the question is, why is it important to investors? Because in our view, we believe that nature is now the next thing, and this is for 2 reasons. On the one hand side, we're seeing a second, let's say, environmental crisis looming, and it's becoming, I think, very visible in parts of the world, and this is a biodiversity crisis. And yet that biodiversity crisis also has a huge impact on the climate crisis. Nearly 25% from all emissions are land use, land based. And I think, and I had it actually, it was interesting. I met the other day an old colleague, and she put it in a really nice way. She thought, I thought always climate was all about energy. And I said, yeah, me too. But actually, when you look at the statistics, it's not. It's actually also all about how the land use change, how it's called in the UNFCCC kind of jargon. And why is this, you could say, well, why is this important to investors? And many investors are saying that. But also investors said this 10, 15 years ago, why should I care about the climate? It's terrible what happens to the climate, but what do I have to do with that? And I think we think it's the next thing that investors will have to deal with. We saw it on climate. It starts off with the problem becomes clear from a policy perspective. The next step is saying, okay, how is it actually impacting supply chain of companies? Who is actually responsible for it? And then how is the finance sector imposed, and what risk does it mean for the finance sector? And then in turn, the moment we're talking about risk, somebody will say, well, that's something I learned in the hedge fund. Everywhere there's a risk, there's an opportunity. So where are the opportunities of investing? And I think it's very true. And I think that's something we've seen. If you look at the playbook, how climate became such an important topic for institutional investors, I think you can see why nature is just the next thing that could follow a very similar path. And that's why we believe that investors will not get around to deal with it. And from the interest from investors that we're seeing at the moment, I think they clearly understand that.
Describe what is a natural capital investment strategy, because you're talking about something that's distinctly investing and not just doing something, making a better world, but you're talking about something where you lay out capital and you expect a return. So what would be a good example of natural capital investment strategy, and describe where is the value in such a strategy?
And I think we have to distinguish between the economic value of nature and the financial value that you provide to investors. But I think you're probably more interested. Well, you're probably interested from where you come in both, right? But I think that's the crux at the moment, that we know that there's an economic value that nature is providing, but we're actually not transporting it into a financial value. And I think maybe that's the easiest way. In an ideal scenario, if you ask me, what is natural capital investing, is that you move from an economic value into a real financial value. And if you can build a strategy around that and you achieve an improvement of nature while also creating a return, then I think that's, for me, that's kind of the gold standard of natural capital investing.
Also, what asset classes are you focused on? Are you an equity or?
We are a real asset equity fund. We are basically, in our natural capital strategy, we will apply also some leverage, but usually we come in as an equity investment, and later on we will optimize the asset with some debt, but actually quite moderately. And so it's similar to what you would see on the infrastructure side.
And also, do you have a particular regional focus?
Yeah, so for the natural capital strategy, we are in developed markets. We're investing in North America, in Europe, in Australia, and in New Zealand.
And then on the nature-based carbon, is that developed countries?
Yes, so that's the nature-based strategy. By definition, it's global, but given the price points that we're trying to achieve, we're mainly active in emerging markets.
Can you tell me about climate asset management's theory of change and the problem you're trying to solve?
We need to move capital from activities that actually destroy nature to actually helping to improve nature. And I think that's something I'm feeling really strongly about, that we only have a chance to address both the climate and the nature problem if we move larger pool of capitals into the right direction. I'm very much subscribing. I'm feeling very proud of myself if I'm able to move the course of a very large institutional investor by 1 degree or 2 degrees, rather than having a very small and perfect investment vehicle with a few, let's say, very sophisticated but investors on the impact side. So I'm a firm believer that in order to solve the big environmental problems we're having, we need to change how large-scale capital is allocated. And that's really our mission statement. That's what we want to achieve, and we're doing it only focused on natural capital. I think that applies to many other environmental problems, but that's really our, if you will, our mission statement.
You've identified two principal strategies, the natural capital strategy and nature-based carbon strategy. Am I saying those right? Is that the way you term it? Yeah. Give me one or two high-level examples of one of these investments looks like, just so listeners can picture exactly what the hell you're talking about, to make sure we're all thinking of the same thing.
On the natural capital strategy, I think the best project I can think of to describe it is we bought 1,800 hectares of land in Queensland in Australia. And at the moment, or that's actually we're just in the process of converting it, but when we bought it, that land had only sugarcane planted on it. Sugarcane is notorious for being a monoculture and also being notorious for needing a lot of pesticides in order to provide the annual yield. And it's also known for having very aggressive runoff into the ocean, which in that part of the world has also severe consequences. For example, the bleaching of the Great Barrier Reef. So what we're doing is we bought that land. We are now converting it to macadamia with cover crop plantings in between. So where we basically moving from a we would say very unsustainable way of producing sugarcane to a sustainable way of producing macadamia. Macadamia is a really interesting investment opportunity, even if you, let's say, forget all the environmental benefits that we are producing with that. It's a super nut. In that part of the world, it's indigenous, and it has a great market in Asia for future demands. It's also an attractive investment opportunity just on its own merits. But what we're doing with the land conversion We are also achieving massive environmental impacts, in particular in regard to biodiversity. And what's special on this project is actually embedded between two national parks. And these national parks have some very rare plants. And what we're allowing is we're always setting aside at least 10% of our land for each of our projects. And with this set aside, we're allowing some connectivity of these national parks. And that means that these two parks can be connected. And one way to enhance biodiversity is to increase connectivity between just to increase connectivity. That's one of the best ways to enhance biodiversity. So if you look at this is a really attractive investment opportunity, but it also has a land use change kind of thesis behind. And we can measure also the improvements over time that we're achieving on the ground.
So primarily it's all real assets,
agriculture, forestry. Those are the main parts of the strategy. Yeah.
And what is your average ticket size?
It depends. It's probably between 30 to 80, 90 million.
And you have a target return that you shoot for?
We do. So it's an 8 to 10. So it's a real asset, normal real asset return.
Can you give me an example of the nature-based carbon strategy?
Just as one, it's a very different activity. So there we are not looking for an investment return in the form of a financial IRR, but what we are trying to do is to help the projects to get off the ground in order to generate high quality carbon credits. And I think one of our best examples is we're working with an organization in Kenya, Malawi, and Uganda called the Global Evergreening Alliance. And there we're actually installing agroforestry techniques with smallholders on the ground. So they're an organization that works with local implementation partners. They've been doing this already for quite some time and showing that mainly by planting trees, they can improve the livelihood of smallholders because with the tree cover, they can actually start to grow other things and they have a much more nutritious ground than they had before, which is also more resilient to drought. So it's a great impact story. We have some very wonderful individual stories, how it improves the life of the underlying farmers. But for us, most importantly, because we're planting so many trees, we're also having a significant CO2 reduction that we're getting certified. And then the certified CO2 emissions we can deliver back to our investors.
So in these cases, you're investing money in acquiring this land and planting these trees.
We are not buying the land there. There we're working with the local owners of the land, and we're basically saying it's a contractual arrangement where we're saying we're providing you a prepayment for the carbon, and for the investment we're making in your project, you're returning us X number of carbon credits over a certain time period. That's how we deal there. It's too complex for us in order to buy the land there. And also it's not an investment strategy where we want to benefit from any value enhancement of the land. We actually don't, we're very happy just to receive our CO2 certificates.
So it's a contractual relationship with the farmers?
Yes.
And so you have the ability to enforce and ensure that these forests don't get chopped down and so forth?
Sure. So you have of course contractual obligations that the counterparty has to fulfill, and there are also some remedies in case things are not happening. But ultimately, if the contract works as per plan, then it's almost like a self-exiting investment in that sense. We're providing the finance up front. We are getting a stream of carbon credits. Once that is delivered, we're out of the project. And the local community maintains the land and also maintains a future stream of carbon credits, which is very important for us because we actually want the local community benefits from these projects. So it's an ability to kickstart the project, to get a certain percentage of the underlying carbon credits to finance that, but to keep the control of the project and also the majority of the benefit with the local communities. That's very important for our investors because of this is the way they want to engage with the underlying project.
And then the revenue is the sale of the credits. Do you have a trading operation?
No, we don't, because we are working with corporates that actually want these credits and need these credits over a time frame. So we're working with some of the investors that publicly announced that invest in our fund, includes GSK in the UK or Carrier in the US. They basically already today have their own net zero targets and know by when they have shortfalls and would like to use carbon credits. That's not today, that's probably in the future, but this is a 15-year strategy. So we are helping them to then receive these credits and they're using them for their own compliance needs. So there's no trading involved in there. So it's a strategy that directly helps corporates, and the corporate funds are used to kick these projects on the ground.
And what is the target return for this strategy?
Well, so we agreed with our investors on a target price. And instead of having an IRR, the way you probably know it in a fund, what we have is for we basically agreed with them a number of carbon credits for a certain amount invested in the fund. That's how we work.
Now for the $64 million question, how are these two strategies interlinked?
I think there are two different ways in order to find a way to pay for nature improvements on the ground. I think that's how they are interlinked. And I think they're by design not interlinked, because as you know, if you're running two strategies for different investors and they're exactly the same, the investors will get very upset about it. So here we have it's actually a really nice setup in that sense that we're saying we have a real asset, developed markets, investment opportunity for an institutional investor, and we have an emerging market, almost like a more procurement product for compliance buys. I think a lot of the techniques we are using, how we're investing in the underlying projects, how we're pricing carbon, how we're assessing the environmental risk around that, how we are measuring the impact, they are nearly the same for both strategies. So for us, we have a lot of synergies between the teams, and we can use a lot of our experts for both strategies. But ultimately, they are distinct, and by design, distinct investment opportunities for different types of investors.
What is your investment process for each of these strategies? Can you describe to me how logistically or tactically or operationally you identify your investment targets? What makes a strong nature-based investment for you?
Sure. I think a strong nature-based investment has to achieve both the expected return and the expected impact. And so we're taking a lot of time and energy on assessing both aspects. So it's not good enough to saying here's a really good, for a natural capital strategy, here's a good opportunity just to achieve a high IRR. What we always say is like, okay, so what's the theory of change? How do we create impact? And how can we make sure that we also hit the target return for our investors? And on the carbon side, it's similar. We're looking into that, okay, we're not only looking for cheap carbon credits, but we're also having an impact framework that needs to be fulfilled. We're looking very closely on how is the local community engaged, who owns the land, who benefits in the end, how can we make sure that we not only achieve the carbon emission reductions, but also leave a sustainable project afterwards and have additional impacts on the ground. And I think, generally speaking, I think the philosophy is that we want to engage in investments where, in really simple terms, where we leave the land that we found in a better shape than we found it.
What would be examples of the key criteria that you're looking for?
On the financial side, when you look at this has to be in, so if you go back from the macadamia project, right? So, okay, we look for an opportunity to generate yield for our investors and ultimately generate the return they want to see. So that's the first one. So how can we do that with the underlying project? So that would be similar. I mean, if you did an infrastructure project, you would look at that as well. And at the same time, we're saying, okay, we're having what we developed on both sides is an impact framework where we have 4 high-level criteria that we're looking at with each 3 subsectors. So we have basically 12 impact factors that we're looking at. And we developed an internal scoring system that is both a combination that you hit as many of the impacts as possible, but that you at least have 3 to 5 substantial contributions to one of the impact factors. And that's the one we're looking at. That's the one we want to improve. And it can be biodiversity, for example. Then we drill down what type of biodiversity. For example, it could be specific plant, or it could be certain birds. For example, in Iberia, we have projects where we're looking for birds. And then we're basically saying, okay, what's our baseline here? And how can we improve this with our investment activity over time? And so we set ourselves, then we estimate initially what the impact could be. And then we basically baseline the project. And then the goal is to increase the selected impacts for each project.
So is it iterative? For example, is it first it has to pass traditional financial analysis and then you look at impact, or is it impact first? Or do you ever sacrifice one over the other?
We had, especially in the first year of our company, we had endless discussions about that. Are we sacrificing return for impact? But ultimately, what we realized is that, of course, it can happen in a certain specific project, but actually becomes very quickly clear whether a project fits with what we try to achieve. Like we always ask my investors as well, what is if you have to sacrifice the impact for the return? And ultimately, it doesn't really fit our screening process. And the way it works is sometimes we get a project saying, oh, wow, this is great. If we could do this, we would have so much impact. And then the question is, okay, but does it stack up on the return side? So we have to do the test on the return. Sometimes it's the other way. Okay, this is a really interesting investment opportunity, but what is kind of the impact story? And this is immediately screened out in the team, but also this is one of the key discussions in our investment committee for each of the opportunities.
So the answer is it depends.
Well, it depends, but actually, you know what? We had this discussion. Yeah, as I said in the beginning, we had this discussion. We are sacrificing returns, but we actually found that there's so many projects out where you can combine the both. That when, for example, I'm a member of the IC. When we see it now, we don't have that black and white discussion any longer. There are always some nuances, right? Okay, can you improve this? Can we spend a little more money here in order to increase the impact? Is that really what we want to do, even though we are already above our impact threshold? These type of things, perhaps. But it's not as binary any longer. But what people fear, okay, you are absolutely sacrificing your impact. We see actually with the strategy we defined and with a longer time horizon, it is actually also in the financial interest of the investors to following them, in particular on the agriculture side, regenerative methods. And I think that's what you see now more and more. And you read it also more and more. There are more studies out there that demonstrate that it's actually not only something good for impact, but also good from a financial perspective. And that's exactly what we're seeing in our project.
Do things such as size or location or stage affect the risk-return profile in your mind?
Initially, we thought, for example, on our real asset strategy, you're achieving a lot more impact if you always go greenfield. But actually, we just engaged in Iberia in a transaction where we bought an existing agriculture operation, and we are now transforming this to regenerative practices. And initially, the first question was, well, can we ever achieve any impact there? And actually, yes, we can. So I don't think it's necessarily the case that you can say because this project is here or is at this stage or is of this size, you produce more or less impact. So I wouldn't say that, because I think I don't know where your question was coming from. Probably is more like you're saying, look, if I go very small and very early, then I tend to have a higher impact. That's not necessarily something that we see in our investment activities.
Yeah, you've given me a range of ticket size, and your experience is bigger, better in terms of cost versus benefit, or conversely, does it lead to a concentrated portfolio?
The whole strategy, when we go to an investor and they're asking us, aside the environmental benefit or the impact, why should I invest in that? And then we're saying, well, you should invest in that because these are uncorrelated assets and these are highly diversified credits. And by having a strategy that combines both agriculture and forestry, we're achieving both from the underlying project type, but also from the geography a huge spread. So we're highly diversified in that perspective.
And with natural capital, are there key risks that you take into consideration?
Well, absolutely. So once you kind of made your assessments, built your models, then you need to start checking, right? You know what is there. So you do a very deep due diligence. One of the first things we do, and I think, again, that's mentioned on your podcast quite a few times, is we obviously want to improve nature, but nature also is one of our biggest risk factor, right? If we're doing an agriculture project, droughts, too much rain, too little rain, fires, all these things are obviously a huge risk to us. So one of the things we're doing is the first step is also to run a climate model because we have a 15-year period to see whether from a climatic perspective, this is actually an activity that we should be able to do in that region. So that's kind of the first lens that you do. And it's interesting what you sometimes find, right? Sometimes it's advantageous even if it gets a bit warmer in a certain part of the world and you're expecting that for certain activities, sometimes it's a real problem. Then I think on the agriculture side, one of the huge risk factors is access to water. So it's having secure water access, being able to use it efficiently, but to use it is obviously one of the key. And then if we do a forestry project, it's things like forest fires and other natural disaster that could be there. So I think those are the kind of the key risks that we assess.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.